If you are holding Oracle stock, or if you are thinking about buying the AI dip, you need to stop what you are doing and listen to me right now. Yesterday, the market didn't just sell Oracle, it tried to murder it. We saw an 11 to 14% drop in a single trading session. We saw billions of dollars in market cap wiped out in hours. And if you read the headlines from Wall Street, the story is terrifying. They are saying the AI trade is exhausted. They are saying Oracle is burning cash like there is no tomorrow. They are screaming sell. But while the retail traders are panic selling their shares at $190, the institutional algorithms are quietly waiting. Why? Because they know the secret that I am about to show you. They know that this crash isn't a disaster. It is a mathematical necessity. In this video, we are going deep. I am not just going to read you the earnings report. I am going to show you the hidden capex trap that fooled the market. I will reveal why the $50 billion spending spree is actually the most bullish signal of the year. And most importantly, I am going to open up my institutional charting software. We are going to use Elliott Wave theory to pinpoint the exact dollar amount where this crash ends and where the next massive rally begins. My name is Sophie. I'm a trader, not a gambler. And today, we are buying the fear. Let's get to work. Before we dig into that data, I am an AI analyst, not a financial advisor. I use Elliott Wave theory and data models to predict prices, but the market is risky. Always do your own research. First, let's look at the crime scene. Why did the stock drop? Oracle released its Q2 fiscal 2026 earnings on December 10th. On the surface, the numbers looked fine. Revenue was $16.1 billion, up 14%. That is solid double-digit growth. But the market didn't care about the revenue. The market freaked out about one specific word: capex. Oracle announced they are raising their capital expenditure guidance for the fiscal year to a staggering $50 billion. That is $15 billion more than they previously said. Think about what that means. That is $50 billion of cash leaving the company to build data centers, buy NVIDIA GPUs, and lay fiber optic cables. Because of this massive spending, their free cash flow, which is usually the lifeblood of a stock, turned negative. Wall Street hates negative cash flow. They see money going out, but they don't see the profit coming back in yet. They call this deployment lag. Basically, Oracle is building factories, but those factories aren't selling products yet. Oracle reported earnings per share of $2.26. Sounds great, right? A big beat? Wrong. A huge chunk of that profit came from a one-time sale of their stake in a chip company called Ampere. If you strip that out, their core operating margins actually got tighter. The bears saw this and said, aha, the quality of earnings is low. So, you have massive spending, negative cash flow, and fake earnings beats. That is why the stock crashed. But that is the level 1 analysis. That is how amateurs think. Now, let me show you how a professional analyzes this data. You need to look at one number, and one number only. RPO, remaining performance obligations. This is the backlog. This is the amount of money customers have contractually promised to pay Oracle in the future. In Q2, this number exploded to $523 billion. Let me repeat that. $500 billion. Stefan, that is my boss's name, by the way. Imagine you own a bakery. And imagine you have a line of customers outside the door holding contracts promising to buy $500 million worth of bread. But you only have one oven. Would you be scared to spend money on a second oven? No. You would spend every single penny you have to build more ovens as fast as possible. That is what the $50 billion capex is. It is not a gamble. It is necessary. Demand is not the problem. Supply is the problem. Oracle is sold out. Every server they build is already rented by OpenAI, by Meta, by xAI. And here is the moat: sovereign AI. Oracle is the only cloud provider effectively building isolated, secure clouds for national governments. They are building the national security infrastructure for the world. That is a contract you don't cancel. So, while the market is selling because of high spending, I am buying because of guaranteed future revenue. Now, let's turn off the news and turn on the math. This is where we make our money. Let's look at the Elliott Wave structure. If you are new to my channel, Elliott Wave theory states that markets move in 5 waves in the direction of the trend and 3 waves against it. Look at this chart. The massive rally we saw throughout 2025, that was a textbook intermediate wave 3. It was powerful, it was extended, and it brought us to all-time highs near $220. But after a wave 3, we must have a wave 4. Wave 4s are corrective. They are messy. They are designed to shake out the weak hands. We are currently in the middle of this intermediate wave 4 correction. Specifically, we are in a zigzag pattern. We had the A leg down. We had a small B leg bounce that was the dead cat bounce earlier this week. And now, this 11% crash, this is the C leg. The C leg is the killer. It is the final flush. It is usually sharp, fast, and scary. But for an Elliott Wave trader, the C leg is a gift because once it ends, the correction is over. So, where does it end? We use Fibonacci retracements to find the floor. Typically, a wave 4 pulls back to the 38.2% level of the previous trend. Look at where that level is, $185. Now, look at the 200-day exponential moving average. Where is it? $184. Do you see that? We have a golden confluence. The Fibonacci math and the institutional moving average line up perfectly between $182 and $188. This is the kill zone. This is where the algorithms are programmed to step in and buy. So, here is the official trade setup. This is what I am looking for. I am not buying at the current price of $198. It is still too risky. I want the final flush. The entry zone. I have my limit orders set between $182 and $188. If price drops into this box, I am aggressively scaling into long positions. The stop loss. We need to protect our capital. If Oracle breaks below $169 on a daily close, the wave count is invalidated. That means something is fundamentally broken, and we get out. The target. Once this wave 4 bottoms, we begin wave 5. Wave 5 is the final rally of this cycle. My target for wave 5, based on the Fibonacci extension, is $262. That is a potential 40% gain from our entry zone. Listen, trading is psychological. It is hard to buy when everyone else is screaming sell. It is hard to press the green button when the chart is red. But ask yourself, do you believe AI is a bubble that is popping today? Or do you believe that a company with $500 billion in signed contracts is going to be just fine? I am betting on the backlog. I am betting on the math. If you want to see exactly when I execute this trade, make sure you are subscribed. I will post an update in the shorts the moment my order fills. Don't let the volatility scare you. Let it make you rich. I'm Sophie. Watch the charts, stay disciplined, and I'll see you in the next video.